What happens if the dollar index crosses 100? What is its impact on India's currency and markets? Hi everyone, this is Prabhanjan Rao from Elysian Investment Advisory. We are a SEBI registered investment advisory providing curated solutions for long-term wealth creation. Today, let's talk about a critical market trigger. What happens if the dollar index crosses 100? The dollar index measures the US dollar strength against major global currencies. Crossing 100 is a big deal. It means the dollar is significantly stronger. So, what does that mean for India's currency, stock markets, and your investments? Let's break it all down. A stronger dollar puts immediate pressure on the Indian rupee. Currently, the rupee trades around 87.5 per dollar, thanks to Mr. Donald Trump. But if the dollar index moves above 100, the rupee could weaken further, possibly hitting 89 to 90 levels or even beyond. Why? Because India imports about 85% of its crude oil priced in dollars. A stronger dollar makes these imports more expensive in rupee terms, adding to inflation. Higher inflation means the cost of living rises and businesses faces higher input costs. What it means for Indian stock markets? A rising dollar usually triggers capital outflows from emerging markets, including India. Foreign institutional investors often pull money out when the dollar strengthens, chasing safer returns and higher US yields. This selling pressure can lead to increased volatility and downward pressure on Indian equities, especially in sectors dependent on imports like metals, oil refining, and airlines. However, exporters might see a silver lining. Their dollar revenue convert into more rupees, but with export tariffs and global demand issues, that benefit is also very limited. RBI's likely response and market outlook. Let's understand this. The Reserve Bank of India has about 640 billion in foreign reserves and can intervene to stabilize the rupee. But sustained weakness could force RBI to maintain or even tighten liquidity and interest rates to control inflation. That means borrowing costs stay high for companies and consumers, impacting the growth. So, what is Elysian's advisory? The practical takeaways for investors. Here's what we advise constantly to all our clients. Expect volatility and prepare your portfolio accordingly. Don't panic, but don't ignore the risks. Consider hedging currency risk if you have significant exposure to exporters or importers. Focus on domestic demand-driven sectors like private banks, consumer discretionary, and infrastructure. These tend to be more resilient during currency swings. Keep a close watch on RBI's policy moves and global interest rate trends. They will set the tone for the markets in the coming months. If you find this video useful, please like, subscribe, and share. Stay tuned for more data-driven market insights from Elysian Investment Advisory. Remember, investing is all about staying informed and being proactive. Until next time, stay invested, invest smart. Have a super Elysian day.